This presentation explores a question many gold investors get wrong. If gold prices rise, why do mining costs often rise too? At first glance, it seems logical that higher gold prices should only improve profitability. But in real mining operations, the picture is more complex. The all-in sustaining cost, or AISC, often increases during strong gold markets. In this presentation, we'll explain why that happens, what AISC actually includes, and why rising AISC does not automatically mean a mining company is becoming weaker. In fact, in many cases, it reflects a changing mine plan, broader inflation, and more strategic investment. This slide introduces the central paradox. The misconception is that gold mining costs remain mostly fixed as gold prices rise, meaning profits should expand almost automatically. The reality is different. Mining companies often report rising AISC in strong gold markets, especially during sustained bull cycles. This may seem counterintuitive at first, but it makes sense once we understand how mining costs are structured. AISC includes not only direct production costs, but also royalties, sustaining capital, mine development, and other ongoing expenditures. That broader definition is the key reason why cost trends often move upward together with stronger gold prices. Here we move from the question to the analytical framework. The presentation is designed to explain why AISC rises, not just state that it does. The main goal is to break down the real composition of AISC and show the economic forces that affect it. For investors, this matters because many people focus only on the gold price and miss what is happening underneath the cost structure. A better understanding of AISC helps investors evaluate whether a company is actually improving margins, expanding mine life, or simply facing inflationary pressure. This is about looking beyond headline numbers and understanding the full mining economics. This slide breaks down the main components of AISC. Many investors think of mining costs as fuel, labor, and processing, but AISC is broader than that. It includes direct mining and processing costs, site administration, sustaining capital, stripping, underground development, royalties, taxes, and byproduct credits. Some of these move directly with gold prices, while others rise because higher gold prices make different mine plans economic. This is why AISC is a better measure of ongoing mine economics than simple cash cost. To understand why AISC rises, we first need to understand what is actually included in that number. This slide shows the main reasons AISC rises in a stronger gold market. Revenue-linked royalties and taxes often increase automatically when the gold price rises. Higher gold prices can also make lower-grade ore economic, which means more tons must be mined and processed for each ounce produced. On top of that, miners may increase sustaining capital, underground development, and stripping to support longer mine life or higher throughput. Industry inflation also matters, because a strong gold environment often raises labor costs, contractor rates, fuel, reagents, and equipment expenses. So higher AISC is usually driven by both accounting mechanics and real operating changes. This slide presents the first half of a simple mine example at a gold price of $2,000 per ounce. In this lower price environment, the company is likely focused on tighter cost control and better grade ore. Production is solid, but the mine plan may remain relatively conservative. Sustaining capital and royalties are lower, and that keeps AISC at a more moderate level. The purpose of this example is to show the baseline. It helps us compare what happens when gold prices move much higher, and management decisions shift from caution toward expansion, optimization, and longer-term mine life planning. Now we look at the same mine at a $3,000 gold price. Production is higher, but so is AISC. That rise comes from several places: higher royalties, more sustaining capital, more development work, and potentially lower average grade, as the mine includes material that was previously marginal. This is a realistic outcome in a bull market. The mine is producing more ounces and generating more revenue, but it is also spending more to sustain and expand operations. This is why investors should not panic when AISC rises in a stronger gold price environment. Context matters more than the headline number alone. This slide delivers the key investor takeaway. Margin matters more than AISC in isolation. Even though AISC rises in the higher gold price case, the mine's margin per ounce expands dramatically. That means the operation can still be much more profitable, despite higher costs. This is the central idea investors should remember. Rising AISC is not automatically bearish. What matters is whether the gold price is rising faster than costs, and whether the mine is converting that into better cash flow, stronger free cash flow, and longer mine life. In many cases, the real story is improving economics, not deteriorating cost performance. This slide likely ties together the major strategic implications. Rising gold prices can change mine behavior in important ways. Companies may stop high grading, invest more in sustaining capital, mine larger resource envelopes, and extend operations into lower grade zones. They may also face higher input costs, simply because the whole mining sector becomes busier and more inflationary. So AISC should be interpreted as a dynamic measure, not a fixed operational score. Investors should watch whether cost increases are being driven by inflation alone, or whether they are part of a broader strategy that actually improves the long-term value of the asset. The final conclusion is that rising AISC during a gold bull market is normal and often misunderstood. It does not necessarily signal weaker performance. In many cases, it reflects a mine that is processing more material, paying higher royalties, investing more in sustaining operations, and preparing for a longer productive life. The real question for investors is not simply whether AISC is up or down. The better question is whether margins, cash flow, and long-term asset value are improving alongside it. Understanding that distinction helps investors interpret mining company results more accurately and make better decisions during gold price cycles.